Hi, everyone, and welcome to this month's edition of On Track. Rob McGregor here. It's the 26th of August as I record this, and we got news right up to the minute, as well as all the performance numbers to the end of July. Let's dive in, but firstly, as always, just a general advice warning. This presentation is designed for clients of McGregor Wealth Management, particularly those that use our care investment methodology and portfolios. Everyone else, welcome to listen, but please seek advice before you act on anything that we talk about here. I'm going to go through all the usual stuff. It's, as always, fascinating time in markets. We've seen new highs hit, which is always interesting times. Causes some people to get excited, causes some people to get worried. We're going to talk about that and just that wonderful quote from Warren Buffett: the stock market is a device to transfer money from the inpatient to the patient, which underpins everything we talk about, which is long-term investing. So let's go through the highlights. And it's all about interest rates a little bit this month. We've seen the RBA drop cash rates by 0.25%, so a quarter of a percent down to 3.6%. So we've now had a couple of rate drops. The markets are predicting one or two more. That would bring rates down to potentially mid to low threes. We've seen mortgage rates drop as well, down to variable rates down to about 5.49. So that's very nice for younger clients and any of our kids that have got mortgages. And there's fixed rates of potentially even lower. So we've seen about, there's a rate of 5.09, but I'll go through rates again a bit later here. That's interesting. At our investment committee meeting last Thursday, part of our reporting showed that 60% of central banks around the world have cut rates in the last 3 months. Now, that's really important, particularly now that the Fed is also looking at cutting rates in the next few months. Their languaging is much more proactive around dropping rates. That just means they're less worried about inflation. They will still, it's not guaranteed till it happens, but it's now looking likely. So what's that mean? Because we've got share market hitting new highs. Down the bottom here, you've got the S&P on the left and the ASX 200 on the right. And the ASX 200 broke through 9,000. Now, we say 9,000 when we know it's been 6 to 7 for the last few years. Let's go, wow, new highs. That's going to cause a lot of people worry. I'm going to talk about what new highs mean and why it's never really a great concern. It's just another factor. S&P 500 also at new highs. Both these charts are 5 years, so it kind of shows the coming out of COVID. So keep in mind as you watch rates, we go 5 years back now, we're the other side of COVID. COVID hit at the start of March 2020. So the COVID downturn is no longer in 5-year numbers or 5-year charts. You can't see the first down leg of COVID, but you can see the steep up leg. So that helps make this 5 years look higher than it really was because we started at a man-made induced low. The tariff deals, everyone's looking past it. They're becoming boring. There's new deals supposedly announced, but when you scratch the surface, they don't really tell us much. I know today Australia Post has stopped shipping to the States, which is absolutely nuts. So it means you can't send stuff to the States because, quite frankly, they don't know how to manage. It's their job as the exporter, officially, the transporter, to make sure all the tariff forms are done. And there's just too much uncertainty at the moment. So sad state of affairs. Pretty sure New Zealand's done the same thing. And we'll see what all that comes through. But the market's looking through that. So the market's making new highs in spite of that. And we did have that downturn early on in the year of March, April, where everyone was worried about that. But it seems the market, in any case, is less worried. So the market's looking through that. It's looking at other things, which I'll talk about in a minute. In Australia last week, we had the productivity, or the week before, we had the productivity roundtable. The Talk Fest, where the government got in all these eminent people and they talked about all things that they should be doing to increase productivity. I'm not sure much of it was actually about productivity, but the one thing I read out of that is it's kind of readily acknowledged that the tax system needs changing. I'm not sure we're all going to love the changes. Watch this space. On the one hand, we've got Albo very conservative about introducing any new tax changes without going to the election. So I think that will slow down potential changes, but we've got a fundamental challenge for the economy as then the government expenditure keeps going up. There seems to be an unwillingness of governments, both parties, but Labor in particular, as the party in government at the moment, to make hard decisions on cutting expenditure. So that means you've only got two choices. If you're not willing to cut expenditure, you're either going into more and more debt because we're spending more than we're making at the moment. And that means the budget deficit goes up, means government debt goes up. That means the interest costs go up, which forces up the government debt as well. So that means there's only one way to resolve that. You've got to increase revenue or reduce spending. I think they're unlikely to. They say they're going to reduce spending, and there's some intermittent bits to do it, but it's not going to solve the problem. So we will see tax increases. All the things that have been headlined seem to be on the table. That includes the reduction of the capital gains tax discount, which I'm hoping won't happen, but I'm preparing for it will. We may see the way super's taxed. I suspect they're building. If we think about the fundamental challenge here, is we've got a shrinking workforce of younger people who would be forced to pay more and more taxes or watch government debt skyrocket because a lot of us older people are paying, this is the impression anyway, less taxes than we should. Now, absolutely understand the argument that we've all prepared for this based on the rules at the time, but I think it's inevitable that there will be some tax on super payments come in over the next 5 years. I think, the super limits, which at the moment are $2 million for pension. Now we've got this new $3 million limit. I suspect at some stage they'll merge or even drop, and the governments will put a limit on how much tax-free and super. All this is speculation at the moment. I did just want to point out that we obsess about these things, so we will be constantly looking for ways to legally minimise tax through structures and strategy and deal with whatever the rules are. So it's an obsession for us, as it has been for a long time, to structure our clients in a way that causes them to pay no extra tax than they legally have to without breaking any rules. So watch this space. I think it's going to move slow, by the way. But the reason I'm talking about it is to make sure we're not too worried about it. I'm finding a lot of people are getting stressed about this, but in the absence of any legislation or any proposed legislation, it's very hard to prepare for anything. If you're worried about a particular asset you had that had massive potential capital gains, if the rates were changed or if the discount was changed, then we can talk about that. But we don't even know whether if it's going to come in, and two, whether it would be grandfathered, so it only applies after a certain date. Watch this space. So hold that thought. Let's look down the numbers. As rates have dropped, so have other rates. Although interesting, the 90-day bank bill rate, of course, dropped because it's pretty close to the cash rate. 10-year bond rates haven't dropped as much. So that means the market's still saying, okay, we're not sure how long this will last. I'll talk about bond yields in a minute. Aussie dollar dropped a fraction. That's fairly normal. If you now get a better interest rate in the US compared to Australia than before this interest rate came about, that'll cause the dollar to drop a little bit till it levels out. If the US drops, that'll cause the Aussie dollar to bounce back a little bit, and so forth. The two things that affect the Aussie dollar the most are interest rate differentials between us and the US. That just means who has the high rates, who has the low rates. In terms of trade, that just means what our exports and imports are doing. Inflation, the numbers now are firmly in the 2 to 3% range, both in Australia and the States. It's now the concern about inflation that may emerge from tariffs, but it's not actually happening yet. No crazy signs of that. Although we did see the States go from 2.4 to 2.7, but still in that manageable range. Interest rates dropping. We can see specials on offer at close to 5. So for anyone with a mortgage or kids with mortgage, that's good news. The flip side is the term deposit rates dropping, not by as much. It's interesting. You can still get 3.7 on a Macquarie 1 year, but keep in mind a year ago or before all the rate drops started, that had a 4 in front of it. So cash not doing as well. That's part of the reason the share market goes up. I'll talk about that in a minute. But yeah, so let's have a look at the numbers. Yeah, they're still showing solid returns. The year at the moment to the end of July, particularly solid, with high growth returns at about 12.5%, growth at 11.8, balanced at 11. They compare really favourably with the competition. So portfolios continue to do well. And those 10-year numbers are pretty much bang on what I've been forecasting for our clients in our projections. And we don't try and forecast because we think we know well. We forecast because we're trying to lock in what is a reasonable expectation of long-term returns. And I've been using these inflation plus 2 to 6 numbers for literally 30 years. And we've seen that they're very much achievable through all sorts of market conditions. And you can see we're getting higher. At 5 years at the moment, we're up, but the 10 years, pretty normal, 8.34% for high growth portfolio in an era of about 1.5% inflation. Is kind of inflation plus 6.5 or 7, in line with targets. We've kept the dial, our money on the move dial, at 10. So we still think the market's a bit expensive, but it's very important to discuss what that means and what it doesn't mean. It doesn't mean the market's in a bubble. I'm starting to hear people use the bubble word. I'm going to talk about that in a minute as well. If we thought the market was in a bubble, we would have it at 14 and we'd be acting very differently. 10 is just expensive. Markets can stay expensive for long periods of time. When we get to some of the charts, I'll just come back to this. The markets can stay expensive for years and profits can actually catch up sometimes as well. We've just finished an Australian reporting season where it was pretty ordinary, but the markets are making new highs. As you can see here on this 20-year chart on the right-hand corner, we're seeing numbers, literally going up to highs, new highs, which the market does. If you look at this chart, every time it gets to one of these short-term peaks, it's a new high. Now, sometimes it'll have a slowdown, and then off it goes again. So these things are normal and inevitable. So the cycles, and once again, firmly in the wall of worry. We are not approaching FOMO, although at expensive, it's that one step closer. If we had another year of, let's say, 15 or 20% returns, then that might start to get closer. But it's always in context with what's actually happening. I'm going to talk about what drives markets in a minute, in actual fact right now. So you'll start to hear news articles about how high PEs are. PEs is price earnings ratio, and that's the way that lots of investment professionals value whether something's cheap or expensive. Now, it's a way of assessing that for sure, but it doesn't tell you anything about what's going to happen next. So here's a chart put out by Macquarie that was presented to us in our investment committee meeting, and it shows 3 things. It shows back to 2000 through 2025. Bear markets, that means markets that dropped by more than 10%. And the longest one in 2000 to 2002 that did coincide with the tech downturn in the US. We had one, of course, in 2008, and then a few other smaller ones. But then they also show recessions, and recessions, which is the black bars, which occur sometimes in a bear market, but quite often not. And by the time we know we're in a recession, we're often near the bottom of the market. But then it shows the price earnings ratios or PE ratios, the blue line. And right now it's high. It's not as high as it has been, but it's high. And then it shows how far it is from the averages. So in the middle line here, we've got the average. Now, put in mind, this is only 25 years. In investing terms, that's nothing. I don't really feel you get information out of things unless you're looking at 100 years. The investment market's a bit like people. The bigger cycles are potentially 100 years plus. Now, most of us only get to go through that once, but there's all these mini cycles in between. But what people say is if price earnings ratios get too high, there's more chance of a bear market. But let me just walk through this one in slow-mo. At the start of the 2000 bear market, the price earnings ratios were 14. Not high at all. In fact, average for the last 20 years. Not sure what it would have been for the year before. At the start of the 2008 bear market, price earnings ratios, once again, about 14. So you'll be looking at average price earnings ratios and going, oh, no chance of a bear market, and yet we got a bear market. 2016, Yeah, a little bit above, but nothing. So when we were high post-COVID, that did not indicate a bear market. At 18 coming into 2022, high, yeah, more than one standard deviation away. So a little bit higher. So we're high at the moment. So yes, it does mean markets are expensive. It does mean there's an increased probability of a bear market being that correction. And when we're at a 10, we're acknowledging there's a significant probability of a downturn of around 10 to 15% or more in the next 12 to 18 months. But what we're not saying is that there's a probability of something 20% or more, or there's not a significant probability. There's always a small percentage probability. So we're saying things are expensive, but they're not crazy. So let's have a look here at why share markets are hitting new highs. So share markets are always looking ahead. They're looking over the hill. They're not looking at what's happening now. We already know that. They're looking ahead at the big things is interest rates, growth in profits and growth in the economy, and then the prospects of individual companies. So all other things being equal, where interest rates are going is what the market's trying to work out. So when you see interest rates dropping around the world, inflation under control, and the market effectively saying, well, I think interest rates are going to go lower. In that case, I'm happy to pay more for growth assets. That includes shares, that includes property, that includes businesses, because every time you value an asset, the interest rate is relevant. If I can put money into a government bond like I could in 1988 at 14%, shares have got to be really attractive for me to invest. And that's when we saw markets at much lower price earnings ratios. If I'm only getting 2 or 3% of my cash, I'm more likely to chase higher returns in the share market or the property market, and that pushes values up. So interest rates are huge when it comes to the pricing of the share market. Growth in the overall economy, both globally and domestically. And yeah, right now that's fairly neutral. Other markets anticipating higher growth around the world? Potentially. We don't know because no one votes on this. You've got to guess at what the market's doing. But no one's, and the underlying thing that's driving a lot of this is technology, particularly around AI and the fact that it may bring all these roundtables about productivity growth. The dirty little secret in the room is technology and AI and robotics and these things is probably going to deliver way more productivity growth than any decisions made in that room, wherever they were last week. So we've got growth in the overall economy. Then we've got what listed companies are doing. So each individual company, what's their profit forecast? We've just finished a reporting season, and we're just finishing a reporting season for ASX companies, and it was pretty ordinary. And in spite of that, the market's jumped. So you're going, wow, the market is expecting bigger profits next year and the year after, and for the next up to 5 years. But no one knows about that. It's uncertain, and that's where very conservative managers start to get more conservative. They'll talk about expensive markets, and some people start to say this is a bubble, but it's not actually a bubble. I want to talk about what bubbles look like. So this is NASDAQ and the .com bubble, and we know it's a bubble after the event, but we also look at the time. So look, some of the key features of a bubble is massively rapid increase in the share price very quickly. So you saw here from 1999, the market doubled in just over 2 years. Then it doubled in another 1.5 years. And if we work backwards from the peak of 5,000 and we go backwards, literally 6 months, it doubled. That's a bubble. So 6 months, I'll talk about how long the ASX has taken to double at the moment, but it's close to 7 years. So 6 months it had doubled, and it doubled twice in 2.5 years. Now, let me put perspective. So if we go back 5 years, to around the bottom of COVID, the ASX was 5,400 or whatever, and we talk about 2 or 3 doubles. That would take the market from 5,000, one double to 10,000, another double to 20,000. Now we're at 9,000. So that's not even one double, and that's from the bottom of COVID. So we're about a 7 or 8 year double at the moment. So what happened? This was a bubble. It eventually burst. But I want to put it into long-term perspective because it's easy to look at this and go, oh, wow, I should have dodged that. But let's say you fell asleep in 1998 and you own good quality tech companies and you woke up 4 years later, they're at the same price. There was a little bit more dip. but then the market continued. Let's have a look at what happened after that. Look at 2000, look at that bubble back there, and look what's happened since. This market has grown and grown and grown, because NASDAQ represents some of the highest growth companies in the world, the Microsofts, the Googles, the Facebooks, the NVIDIAs, and all these things. So if you just said, you know what, I'm just going to ride this all the way through, you've made an incredible amount of money. The attempt to trade markets is always very hard. Now, we're wary of things. We do things like rebalancing. So as different sectors go up, we'll sell a little bit to buy stuff that's not going up by as much. But we do not think we're anywhere near a bubble. A bubble would be Aussie market at well north of 13, 14, 15,000. And depending on what profits are doing, we may change our mind on that. So I think profits, interest rate, world growth, they will all affect markets. As all those things potentially start to look worse, that's when you see corrections or bear markets. But yeah, I just want to cover off on that this month because there's talk of new highs, and I just don't think you should be worried about new highs. These scales are notoriously bad as well. They're linear scales. So a log scale will show that more stretched out. So in other words, the rise from 10 to 20,000 here looks staggeringly steep, but it's just a double. It's no different from the rise from 10 to 5 or the rise from 5 to 2.5, which look different shapes because of the way a linear scale works. Let's look at our exciting life, boring money segment, and there's a lot of dramas going on in different places. This was from an article from the ABC, but it's a hot topic. Some of you may have seen it, but there's literally been a couple of failures of investments that a small handful of advisors, some of them who will probably go to jail, put advisors in. So let me highlight this. So First Guardian was one of them, and through there was a company set up called Venture Egg, and they talked to a lot of people, literally 2,000 people, into moving their super into one investment called Guardian. Now, this was no diversification. When you see your asset allocation charts, you'll see Australian shares, international shares, property, fixed interest, and other. This was all other. It was private equity, effectively private credit. So you're giving money to a company who was going to invest it how they liked, and you weren't going to get market-linked reporting on that. Now, this was a lot of naive, innocent Australians. They were all recruited by telemarketing, and they're all seduced by sales talk. And some of them will end up going to jail. Not so much the advisors, but the people that were promoting this company, and some of them who were related to the advisors. When I say related, I don't mean cousins or anything, but I mean the promoters of the company, and they were paying kickbacks, which were illegal in this case. So there's Guardian and Shieldmaster. One of them was 480 million. It affected 5,800 people. The other one was about 600 million. Have I got that there? 590 million, with Guardian that affected 6,000. So 12,000 poor Australians have lost 1.2 billion. So tragic. Now, there's multiple blame here. One, I don't know, like victim blaming at all, but to fall to a internet market, so an online, telemarketing campaign, and then advisors putting you into one asset. And keep in mind, this is one investment. So when we go into one asset like VAS, which is the ASX 200, it has 300 companies that it's investing. And some companies like the S&P 500, there's 500. So you guys, through the care process, literally invest in literally 5 to 10,000 different individual investments. This was one investment. It was a private investment, and watch this case. There'll be people going to jail. The annoying thing is the authorities, ASIC are now considering legal action against all sorts of people, including the platforms that it stood on. So as I said, there's blame for the punters here. There's blame for the financial advisors that put people in. There's blame for the licenses that license those financial. The promoters are the ones that have acted illegally. Everyone else has acted stupidly. But the promoters here, there's been literally 60, 80 million paid in marketing allowances. One of the promoters, one of the founders of one of these funds, I think it was the Shieldmaster Fund, has transferred $270 million offshore. He's had his passport banned. He will go to jail for a long time, I hope, if the facts are true. Yeah, so it's very hard to stop bad eggs, but this is where ASIC's trying to push more responsibility onto the trustees of the super funds of the platforms, which included some big names, including Macquarie, NetWealth, equity trustees, etc. But anyway, that's one of the reasons why it pays to do due diligence and work with people that have long-term reputations and use boring old principles like diversification, etc. Back to the markets, and you'll see here the 10-year yield curve, both in Australia, where the bottom end has dropped, and to the US, where you can see the prediction. So the green line is showing the market predicting that short-term rates are going to drop in the next year or so. And then the 10-year bond rate hasn't changed too much. You can see there 4.2 in the States, 4.2 in Australia, some slight difference, but pretty much the same. But because Australia's dropped a little, that has brought our currency down as well. Look, while we're on this chart, this is there to show our cycle, our wall of worry cycle. But on this chart, I'll show that the market's always making new highs. And if you can see my cursor here, every time I look at a new high, I go, wow, that was a great time to invest. Here's a new high. That's a great time to invest. There's a new high. What a great time to invest. Here's a new high. What a great time to invest. New highs are nothing to be scared of. Let me use an analogy, and I'll need you to think visually here. If you were standing at the top of this mountain of the share market and you're looking backwards down the mountain, you could get dizzy and say, wow, we're at a new high. But if you're standing anywhere along this mountain and looking up at what's possible, you're going, wow, there's so much more to come. Mountain after mountain after mountain after mountain. And that is exactly the way we need to think about these things. Yes, new highs can sound scary, mainly because the media pumps them up and makes it scary, but mainly because we look backwards instead of looking forwards. So I recall very vividly when the ASX, well, the All Ordinaries, as it was then, broke through 3,000. And, it's up nearly 10,000 now, the All Ordinaries index. So, but at that stage, people were calling doom and gloom, and this is back in the late 90s, early 2000s. And, calling doom and gloom, but of course, those new highs are just the start of the next mountain range. So all of that's driven by the psychology. I'm not going to go through any of that this time, but any declines, and we're certainly at a new high. We're at a 10, so we think corrections and shallow bear markets, which would be anywhere from 5 to 15% are probable. We have the portfolios aligned for there. We don't think it's probable of market drops by more than 25%. Everything in between is harder. We'll continue to analyze that as a key part of what we do and adjust portfolios. Now, what I've highlighted here, and the most investors mess it up, is just that. Most investors mess it up through all these things we talk about, but it's seen, just to repeat that Dalbar study, it's seen by the return that investors get being totally under the return that average investments get. So in this 30-year Dalbar study, which is shown here, it shows the average, the S&P 500, the US share market went up by 10.15%, but the average equity fund investor only got 8%. Now that difference is their behavior, and it's because they mess things up. That has been persistent over all the research over the last 50 years and continues to be a thing. One of the behavioral biases, and this one I show a lot for those of you that are saying, hasn't he talked about this before? There's probably about 10 to 12 main behavioral biases, another 10 to 12 more rare sort of ones. But this one is the most common. It's called recency bias, and it's the fact that we overweight information that's new and available. So we're always focusing on now as if it's so important. But if we go back and, in my wall of worry chart, if I said, tell me why the market dropped in 2012, and it dropped 17% back then. There's no way anyone remembers why that was. No way. Unless you're looking at one of my charts where it's got it on there, which shows that we were worried about the Greek crisis causing problems with the rest of Europe, etc., and the market dropped 17%. But we thought that information was so important, and in hindsight, it just wasn't, and it never is. We think whatever's going on, the trade wars, whatever it is at the moment, all this stuff is unprecedented. It's not. It's happened before. It'll happen again. Companies get busy working out how to get through it and get on with it, and that will continue. So recency bias in focus there. I just want to point out again, when we look at our four pillars, the importance of having a plan that's being executed well, that allows you to ignore all this noise and enjoy long-term returns with occasional hiccups, which are normal. So, and that is a plan based on your goals, and particularly that last bit, managing liquidity. So that means for our retired clients having enough in short-term assets, they never have to sell good assets at a bad time, which has always been the case. Onto the market results, and ASX 200, 8.9% for the month. So absolute cracker of a month. We're sitting at 11.8% for the year. And that's because the year's got this big V in the middle where it went up, it went all the way down, and then it went up again. So, but if you look at the 10-year averages, or if you look at how long it's taken this market to double, and it's about 7 or 8 years. And if you go back here, if you go to the bottom chart here, you can see that the index has grown $10,000 into 25,000. If we go back to when that was 12,000, that's about back 2017, so about 8 years ago. So 8 years to double is pretty normal in the share market. When I say normal, that's the average. It can double quicker, it can double slower. So not in bubble territory. US shares, which have been the center of price action in the world, particularly with that magnificent 7 that we talk about, up 4.9% for the month, 18% for the year. This is looking warm. This is why we've got the dial at expensive. It's actually doubled in just under 5 years. So from 44,000 back to 22. And if we look at the pre-COVID 22, 2021, so 4.5 years. Now that's shortish, but that makes it expensive. But keep in mind that .com NASDAQ bubble, where the market doubled in 6 months before it burst there. That was absolute bubble territory. So we would rate this as expensive, but nowhere near bubble territory. Same with global leaders, very similar numbers to the US market, because a lot of these companies are US. And US small cap shares actually been the worst performer for the year, a negative. So quite amazing that US small caps in the heart of the US, where the large caps are going gangbusters. But the way we're thinking about this is this phase of AI and tech is rewarding the big tech providers. So the AI engines and the big tech companies. So there's only about 7 AI engines in the world. ChatGPT, Gemini from Google, Copilot from Microsoft. And the ownership of those is concentrated in about 7 hands. There's lots of companies that have software and other things that tap into those databases, but they provide the infrastructure. So you've got layers. You've got those big companies making lots of money now and at high valuations. And then you've got the next wave, but then you've got the companies that will benefit in the next 5 years. And that's probably going to be, I would almost bet money, well, we do bet money on it effectively by investing. Small cap companies will benefit from the next wave where they start to implement practical things that lowers their costs. And where they lower their costs, they increase their profits, or it allows them to be smarter with their marketing and all these things, of which AI will do for lots of them. So we fully expect that next wave of growth to be more spread out and benefit some of those. Same with emerging markets. Emerging markets were a problem child last year. They've had a pretty good year this year at 18%. So it's had a comeback. Some of those top companies there are absolutely involved in tech. Taiwan Semiconductor, Alibaba, Tencent, or the equivalent of the Facebooks, the Amazons, etc. in the States, but selling at much lower multiples. So we still view emerging markets as cheap, and that's proven very well for us in the last 12 months. Gold, it's been quieter lately. So for the year, it's 36%, but you can kind of see that peaked about May, right in the middle of the share market downturn. And it's actually gone down a little bit in the last, the last 4 months, last 3 months since May. But we still think it's such an essential part of the portfolio. And it's given extremely good returns in the last couple of years. Every time the world goes a bit crazy, gold tends to go up. And then when the world starts to look a bit more normal, gold tends to go sideways or down. It's a small part of the portfolio, but important in that insurance policy. Let's get into property, and the same thing. We have our wall of worry. We've got our boom bust model there. I found this slide interesting, so I've included it from the AFR, which shows the change in housing prices in the 2 years after the start of a rate cut cycle. So once the Reserve Bank starts to cut rates, what happens to property in the next 2 years? And you can see everything from not much, 1984 and 1992, 65% to way up 60% after the cut in 1988. Now, I would point out that was driven by a couple of things in 88. One, people massively pulled money out of the share market, which had been running hot for 10 years, and they just threw it into property. We had interest rates dropping massively in response. So all of a sudden, mortgages had gone from 17% and they were dropping down to 12 and stuff like that. So here's where interest rates really make a difference. 2021, right on the end, we see that 27% increase in housing price over 2 years off the back of COVID and the rate cuts that came with that. So we're now a few months into this rate cut cycle. So what this is implying, but absolutely no guarantee, is that if you were averaging this out, and I hate averages, but you'd expect a 20% increase in property prices over the next 2 years. Now, I'm not going to forecast that or quote that, but pretty comfortable for people buying smartly. And that leads us to what's happening around the country. The monthlies evened out, so pretty similar from 0.4 in Melbourne, still the laggard, to 1% in Perth, still the superstar of the Australian property market, and average in between for Sydney, Melbourne, Brisbane over the 1 month. 1 month doesn't tell much of a story. 12-month, Melbourne still the laggard, the leader Brisbane at 7%. Very ordinary numbers these, they're not crazy numbers. 6.4 in Adelaide, 6.3 in Perth, combined capital cities 3.2. Nothing staggering or scary there. And you would expect this to kind of continue. The data here that comes from CoreLogic, now known as Cotality, shows, I look at this chart at the top, but it needs a bit of explaining. So all the orange things are the lowest 25% of value. So picture Noosa, where I'm sitting right now. The top 25% of properties are all $5 million plus. The lowest 25% are maybe 900,000 and below. And the middle is probably on the 1 to 2 million. And they're just my guesses. But you can see here the wide variety in different cities. So in Sydney, all the price growth is in the middle. So that's 2.3% growth. And as we look across, a lot of it's in the lower. Brisbane, it's all in the lower and middle. For Adelaide, it's all in the lower and middle. For Perth, it's all in the lower and middle. So this market is hot for young first home buyers, for second home changes as interest rates drop. So there's more action across the country in the lower sectors, lower price sectors, than there is in the high price. In fact, Hobart top end dropped in the last quarter, 0.3%. 28-day rolling average home changes. So that's an average that goes back to 2024. So you'll see the difference between capital cities and regionals there. With capitals, they finished the same, ironically, but the capital cities dropped and then came back. Regionals were solid during the year. This was interesting, and I show this every so often. Instead of median prices, it's asking prices. So it shows what's actually being asked for. And it breaks it down between houses and units. From Sydney, the median asking price at 2,026,000. Excuse me. Units at 872. Melbourne lagging as far behind Sydney as I've seen, particularly units. 633. Units in Brisbane more expensive than units in Melbourne. Units in Perth more expensive than units in Melbourne. And then we've got Adelaide, Canberra. So you can see some of those numbers there. On average, the capital city average the median asking price for houses 1.4 million and for units 740. Quite staggering numbers, but numbers just get bigger as time goes by. And you see the changes in the right-hand columns for all of that. So up 6% annual change in Sydney, 4% in Melbourne, 11%, and 16% in Brisbane, Perth, 11% and 18% as well. You see units coming back, and some of our advisors we speak to, some of the property gurus, that we talk to, are thinking units in lots of areas are making a bit of a comeback. Mortgage rates are driving it. So you can see the lowest fixed home rates now at about 5.3. And you can see specials down to about 5. But this is the average home rate. So you should be doing way better than this. The average home rate still says 6.15, but that's because banks will rip you off if you don't go back to them and ask for better rates. So new rates, like we saw, about 5.4 at the moment. So if you're not getting mid-5s, you should be renegotiating or refinancing. Yell out if you need some help with that. And fixed rates are now getting interesting. So if you're a 5-year fixed rate now at 5.78, there's 2 reasons to fix rates. One is if you think rates are gonna go higher, and that's the predictive rate, and that's hard to know. But the other is if you just want to know what your costs are. So let's say you're buying an investment property and you want to lock in the costs for the next 5 years. If you can afford that investment property at the 5-year fixed rate, there's a good reason to lock that in, regardless of what you think. Rates are notoriously fickle to predict. Everyone thinks they know exactly what's going to happen, but it's very often doesn't go that way completely. So if the numbers work, fixing rates right now is okay, particularly on investment properties, particularly for that longer term, where if the numbers work, and yes, you may miss out if rates go down more, but what often happens is rates go down, that will drop variable rates and the 1-year and 3-year fixed. It doesn't always drop the 5-year fixed, but we'll watch this space. We'll see what this cycle is going to do. And lastly, finishing up with our property clocks, no real changes here. So we're still seeing more value around Melbourne in the blue chips starting to come into its own. That's because it's been battered and it hasn't risen by as much as anything else. All other things being equal, that should make it more attractive. But there's still some significant economic risk to Victoria at the moment. But immigration's still coming there. I know there's a march on immigration on Victoria this weekend, I think it is. Melbourne population's doubled in the last, I think it's 15 or 20 years. It's hard to know whether road capacity and all these other things have doubled in that time. That's making people angry. So there's going to be this populist movement against immigration. Make no mistake, you slow immigration, you slow down property price increases. Be careful what you wish for, but that's a long, complicated area that I won't go into. But generally, both Australia and the US have relied on population growth through immigration to pump economic growth, and that's led to share market and property prosperity and growth. You reverse that, you can change that as well. But point of this slide is there's plenty of places to be investing. Should investing suit your plan at this stage? And as always, if in doubt, talk to us. So just finishing up, reinforcing our process. A core belief is that all investing is best done as part of a real plan based on your goals, your reality, what's important to you, portfolio designed to meet those goals. We take a long-term view, but we're very cognizant of the short to medium term. We don't just say, do this and forget about it. We've got lots going on, including asset allocation, diversification, liquidity. We do rebalance to get that asset allocation and diversification consistent. That makes money. And then the low-cost exposure to index funds, and protecting its short-term market volatility through reserves and dollar cost averaging, rebalancing, and as always, only 3 ways to lose money in the share market: panic and selling, having to sell, and not properly diversified. If you get those right, if you have the liquidity survive through, if you're well diversified, you see the results that you've seen with good long-term returns. And these little periods, well, this is an upward period. It's nice to pat ourselves on the back, but whenever it's going hard, I'm always trying to prepare people for the next little downturns because we know they're inevitable. But I just wanted, the main theme of this has been not a bubble, just expensive. Expensive can run for a long time. Enjoy the rise. Expect corrections. But yeah, unless your plans have changed, no need for changes in long-term strategy. That's it for this month. So until we speak again, signing out, and I'll talk to you soon.